An ETF is supposed to be a simple choice. Then you open the app and there are 2,000 of them, and most videos are just arguing about which ticker to buy. Meanwhile, the thing that actually decides whether you build wealth and a tax that quietly skims 15% of your US dividends in the account you thought was tax-free never comes up. Here are the 7 things that do matter. I'm Toyin, a CPA and MBA with years of real client work behind me. I'm glad you're here. Everything here is general financial education, not advice tailored to your specific situation. I don't recommend specific investments, funds, or securities, and nothing in this video is a suggestion to buy or sell anything. If you want guidance built around your own numbers, your debt, your taxes, your plan, work with a qualified professional who knows your full picture. On those topics, that can be me. Otherwise, take what's useful here, check it against your circumstances, and make the call that's right for you. A lot of people feel like they don't know enough about ETFs to buy one. And that feeling pushes them one of 2 ways. Either you don't invest at all because you don't want to make an expensive mistake or look foolish, or you copy somebody, you buy whatever a video told you to without really knowing what you're holding or why. And neither of those is a you problem. Nobody ever showed you which part actually matters. So all of it looked equally important. I'm here to show you the part that counts. By the end of this video, you won't be copying anyone. You'll understand what you own or what you're about to buy. If that's useful already, tap the like button. It tells YouTube to put this in front of more people who feel like they don't know where to start. Thank you. Before the list, what an ETF actually is. An ETF is a basket of investments. But so is a mutual fund, and so is an index fund. So the basket alone isn't what makes it an ETF. 2 different words are doing the work here. An index fund describes what's inside. A basket built to track a whole market. Exchange traded describes how you buy it. On the stock exchange, all day, at a live price, like a single share. So an ETF is really a fund you can buy and sell in seconds, like a stock. And most of the popular ones happen to track an index. Everything else on this list is just details sitting on top of that. The first thing to know about the advice you've probably already heard: just buy one all-in-one ETF. I've given that advice, and that advice is good. An all-in-one ETF is a single fund that holds a whole global portfolio for you, thousands of companies, stocks, bonds together, and it rebalances itself. For most people, it's a brilliant, calm, boring default. But all-in-one does not mean one size fits all, and that's where people slip. These funds come in different blends. There's an all-stock version like XEQT, and there are calmer ones with a chunk in bonds like XGRO. The all-stock one that's perfect for someone in their 30s can be too aggressive for someone 3 years from retirement. The fund picks a risk level for you, and it might not be yours. So the convenience is real. You just have to match the blend to you. I'll show you how to find yours. The second thing is the fee, because it's the one number you're guaranteed to pay. It's called the MAR, the Management Expense Ratio, and it comes out quietly every year, whether the fund goes up or down. The cheap broad ETFs charge somewhere between 0.17 to 0.24%. The old balanced mutual fund the bank sold your parents often charged north of 1.7%. More than 10 times as much for basically the same mix. There's also a small one called the Trading Expense Ratio, the fund's own buying and selling cost. So your true yearly cost is the MER plus the Trading Expense Ratio. On broad index funds, it's tiny, but it's real. Here's why fee matters. On $100,000, that fee gap is over $1,500 a year. Every year, win or lose. And because it compounds, That little percentage can quietly cost you into the six figures over 25 years. Fees are one of the only things you can control in investing. So control them. If you'd rather know the one number that's guaranteed than guess at the ones that aren't, subscribe. That's the whole job here. Making your money calmer and your decisions simpler. Third thing, and it surprises people, not every ETF is the cheap index fund you're picturing. ETF is just the wrapper. Most are cheap and broad, but plenty are active or thematic or covered call funds charging 0.4, 0.55, even past 0.85%. Same three letters, several times the cost, and often holding something far narrower than you think. Before you assume an ETF is cheap, check two things: the fee and what's actually inside. And one quiet extra, check that it tracks its index closely. A cheap fund that does a sloppy job following the market isn't the bargain it looks like. This next one is the one that actually matters, so stay with me. People spend weeks agonizing over XEQT versus VEQT versus the BMO one. I'll be blunt, that's the wrong fight. Across the big brands, the all equity funds are nearly identical. The decision that changes your life isn't the ticker, it's your mix of stocks to bonds. I call it the dial. More years until you need the money, turn the dial towards stocks. Closer to needing it, turn it towards calmer bonds. Set the dial to your timeline, and which brand you pick is close to a coin flip. And the good part, an all-in-one ETF makes that one decision for you in a single purchase, then rebalances itself. So you never have to log in and tinker. The fifth thing is where the accountant in me comes in. Where you hold the fund can matter more than which fund you held. The same ETF behaves completely differently in the TFSA, an RRSP, and a regular taxable account, because the taxman cares what's inside the basket. $1 of Canadian dividend, $1 of foreign dividend, $1 of interest from bonds, and $1 of capital gain are all taxed differently. Inside a TFSA or RRSP, none of that touches you. In a taxable account, it decides your bill. That's why which account you fill first is a real decision and not an afterthought. If the idea that the account matters as much as the fund is new to you, that's exactly the kind of thing I write up every Sunday. One short letter, one idea, about 5 minutes, no hype. It's free at cpamoneymentor.com/moneyletter, or just click the link in the description. A steady voice in your corner. Now, the account question has one more layer, and it's the one I watch people miss the most. When a US company pays a dividend, the US government takes 15% before it ever reaches you. It's the withholding tax. Now, watch where that 15% lands, because it's different in every account type. In your RRSP, a tax treaty between Canada and the US waives it. You can keep all of it. In your TFSA, the account everyone calls tax-free, it is tax-free. The treaty's exemption for retirement account doesn't reach it. The 15% gets taken, and because a TFSA pays no Canadian tax, which is why it's tax-free, there's nothing to claim it back against. Because there is no tax deduction. It's simply gone. In a regular taxable account, it also gets taken, but you can recover it as a foreign tax credit when you file. Same fund, 3 completely different outcomes. Now, this doesn't make US dividends in the TFSA a mistake. If your RRSP is already full, the TFSA is still a great place to be. It just means that 15% is the quiet price of holding them there. So if you have the choice, the RRSP is the better home for your US dividend payers. And here's the one that catches careful people. If you hold a Canadian listed ETFs that owns US stocks inside your RRSP, you lose that treaty break because the fund holds the American stocks, not you. The tax gets taken down at the fund level where you can't reach it. Do you need a US listed fund to own US companies? No. A simple Canadian all-in-one is completely fine for most people. Just know that if you're holding a big pile of US dividend payers, the account you choose is quietly worth real money. There's one more reason that simple Canadian funds keep your life easy, and it's pure paperwork. If the total cost of your foreign property ever goes over $100,000 in a year, and property includes investments, not just physical property like real estate, you have to file a form with the CRA called the T1135. US listed ETFs and US stocks you hold directly count towards that $100,000. But a Canadian listed ETF that holds the exact same global companies does not, because it's a Canadian fund on the Toronto Stock Exchange. Same companies, no form, and anything inside your TFSA or RRSP doesn't count at all. So the boring Canadian basket saves you a filing headache on top of everything else. The last thing to know is built right into how an ETF works. Because it trades like a stock all day at a live price, one tap to buy or sell, it quietly tempts you to act like a trader. People genuinely ask if this counts as day trading. Owning an ETF for the long haul and day trading one are completely different things. The fact that you can trade it all day doesn't mean you should. Once your dial is set and you've picked one low-cost basket, the right move is to basically stop. No checking it every day. No selling the moment a headline gets scary. No chasing whatever did best last year. The fund does the work, you go and live your life. The boring, calm investor who leaves it alone usually beats the busy one who keeps tinkering. Do almost nothing on purpose. Now step back and look at all 7. 6 of them are details. 1 of them, your mix and your accounts, is the actual decision. After years of doing people's numbers, here's my honest take. The basket was never the decision. Your dial and your account were. Get those 2 right and the ticker barely matters. Most ETF videos hand you a fight between 2 funds that are practically twins and never once mention the 2 things that move your money. And look, reasonable people weigh these things differently and your situation is your own. But that's where I land. Screenshot this. Before you buy anything, 1, check the fee and what the fund actually holds. 2, set your dial, your mix of stocks and bonds, to your timeline, not your mood. 3, if you want simple, one all-in-one ETF is already a complete portfolio that rebalances itself. 4, put it in the right account. Your big US dividend payers belong in the RRSP, where that 15% is waived, not the TFSA where it's lost. 5, in a taxable account only, keep track of your adjusted cost base. Your ETF can hand you a reinvested distribution at year end. That's taxable, even though no cash shows up, and it raises your cost base. If you don't record it, you end up paying tax twice when you sell. Your brokerage might not always track that right, so keep your own note. 6, going global, reach for the Canadian listed funds. Same exposure, and it keeps you off that T1135 form. Before you ever type a ticker, you now know the 7 things an accountant checks first. The fee, what's inside, your dial, your account, and the discipline to leave it alone. That's the whole game, and you're already ahead of most people at the barbecue. I'm curious about which account your US funds are sitting in right now. Tell me in the comments. And if it's the TFSA, no panic. Now you just know the trade-off. If you want the very next step, which single all-in-one basket actually fits your dial, I broke that down right here. Watch that one next. Thank you for watching, and I'll see you in the next video.